Thanks, Emily, and thanks for everybody who is joining us today. I know we have a wide variety of industries represented here. I looked at the list yesterday and I saw a lot of nonprofits, some manufacturing, some co-ops. I think I might even seen maybe construction. So while the presentation is going to be, we're going to try to keep it broad, but just, I guess, keep in mind that, you'll have to tailor the forecast to your individual specific scenarios. And as Emily said, I'm a senior manager and I primarily work in our audit department. I do a little bit of tax work and advisory work as well. The clients that I work with are kind of across the board. I do a lot of nonprofits, a lot of manufacturing, some construction. In prior years, I've worked with co-ops as well. Kyle?
Hi, everyone. I'm Kyle Kadra, a manager in our assurance department. Mainly do audit work and review, test work, also some advisory work as well. Primarily commercial type clients are my focus, specifically manufacturing and distribution type entities. But yeah, we've worked quite a bit with these commercial type clients and focus a lot on these advisory type services already. And I think an important issue of, the way the environment is happening now, I think this cash flow topic is magnified more so than, other times. So it's a great idea and great topic to discuss for all of our entities and clients on the call today. But we wish everyone to stay healthy before we start in this new environment that we're in. I think right now is the most quiet my house has been in the last few weeks with the kids gone on a car ride with my wife. So it's been an interesting environment being home with the last 7 weeks or so, working remotely with Wagner. And I know you guys are all have different environments that you're working in and adapting to that. So just to start out, we wish everyone kind of stays healthy and is ready for this topic as we discuss. So I think to start off, we just want to kind of get a gauge of what you and your businesses are experiencing with cash flows and forecasting. So you can see the question here, is your experience extensive? And this might be a refresher. Are you an intermediate at it and you haven't done it in a while, but it should be fairly new, or completely limited and most of this will be new topics?
Give just a couple more seconds.
All right, kind of what we expected. That pretty well represented bell curve there. So again, as Tim discussed, there's a wide range of individuals on this call, different types of industries, different size clients per se. So we're going to try to make it as broad and overarching as possible. And some of it might be too granular, and some of it might be overarching. So we'll try to address that as we go through the presentation. So our agenda here today, really we're kind of focused on what is cash flow management and forecasting. Why do you need to do this in your organization? What are the benefits from doing it? Really looking at why is it important? What are the metrics that you use to make sure your entity is successful? And ultimately you need to find out where you need to start. So it's an understanding of where your entity is and what you need to have in front of you to present this forecast and this model. Ultimately, you're going to need some certain assumptions and items before you get started on this, and we'll talk through that. And then lastly, we're going to walk through the exercise of actually presenting the model, setting it up, working with the different assumptions, working with different aspects of what you need to know to make sure that you have the most accurate model in front of you so you can be the best prepared for the next 13 weeks, 6 months, a year, but just trying to work through this new environment and the pandemic that we're in now. So what is cash flow management? The objective of cash flow management is to forecast and manage timing of cash flows to assure cash flow availability to accomplish your company's mission. So sort of what I just said, you know your entity well, you know what you need to do to be successful. But really it kind of gives you a strong handle on your current situation. You get to evaluate your current cash position and your current working capital needs and cost structure. Cash flow really is in simple terms, it's the money in and the money out. You need to make sure that a lot of our entities here are on accrual basis, and you look at your entity as such. But cash flow management is really looking at items on a cash flow type basis. So what is going in, what is going out, and it's not essentially just sales, it's not profitability. If you have net income, you might not have a cash flow positive entity. So it's really understanding this whole aspect, making sure you're aware of, what is your cash tied up in? Is it tied up in inventory? Is it tied up in receivables? Are you able to service any of the debt you have? Items like that, just understanding the environment that you are in to make sure you're able to use the funds accordingly. So what is a cash flow forecast? You look at the results you have in front of you, and then you make certain assumptions about the conditions that you have. And from that point in time, you're able to see what your cash position might be in the given period. So ultimately, you want to set your time period for your forecast. Here, we're looking at a 13-week time frame, which is about a quarter, and we'll discuss that. But it might be 6 months. You might already do a 6-month cash flow. You might look at it during a year. But it's important to know what is the time frame you're looking at when you get started. These cash flow projections really assist companies, and that develops a model to give them a more clear look at their cash perspective. I mentioned assumptions before, but this is a key aspect in developing an accurate cash flow projection. It's not going to be an exact measure, but it will be fairly accurate and give you, insight to where you might have potential shortfalls. But these assumptions are important. You might have your current sales right now, but you're going to have to look at your sales forecast beyond the first 5 weeks to 13 weeks, and really make sure you have a strong assumption on that. With the sales you have outstanding, how long does it take for the cash to come in the door? Conversely, with purchases, how long are you taking to pay your vendors? Can that number change at all with negotiations or talking with your vendors, with the relationships you already have? And really assessing your working capital needs is important. And ultimately, these forecasts need to be monitored and reacted to. It's important to be proactive rather than reactive. It's important when you look at this model, you set it up, you feel comfortable with it based on the assumptions and work you have in front of you. You're going to want to address that after weeks 1, 2, and 3. How did that compare to actuals? Did any of your assumptions change? Were there any changes in your customers or sales forecast that's going to change your forecast? Were there any changes with your vendors? It's important to really look back at your forecast and know that it's not a stationary tool or stationary document. It's definitely a fluid approach to making sure you're best equipped for any changes that might occur. So why do you need a cash forecast? And is the simplest form, you want to make sure you do not spend more cash than you expect to have. As simple as it is. Some entities are different. Maybe you're at this time looking to make sure that your cash balance doesn't dip below, arbitrarily say, $100,000 or $50,000. You, based on your historical operations, you know that you need a bottom line of cash to operate efficiently. Maybe you're making sure that it just doesn't go to zero. By setting up this weekly forecast, you're able to see, where there might be shortfalls down the road. You have receivables coming in, you have to pay your vendors. Historically, things have gone smooth, but times have changed. So can you look at this form, this forecast, it's in front of you. Are you able to look at this to see if there's adjustments that need to be made right here and now. And having a cash forecast is really important because you're able to see the effect of maybe some changes you might have before you actually commit to that change or that pivot per se. If you need to look at reducing staff or extending terms or not investing in new equipment, by laying this forecast out, you're able to see, what that might look like 8 weeks from now, 10 weeks from now. And is that your initial change? Does that really affect your cash flow position? As Tim will look on later, sorting through the forecast itself, we're able to see and change the variables to see how much this cash position might change. But having this tool in front of you really helps you tweak and monitor what may or may not happen. But really, the purpose of cash flow forecasts, even more so than just in this environment and pandemic that we're in, it really helps you anticipate short-term financing needs. If there's certain weeks or months that you don't have cash available, it helps you look at your debt service, making sure you're able to cover that. You can help plan for capital expenditures, looking for investment income, and also based on this cash basis, you're able to look at if your company has any seasonality. Does cash come in more in the summer than it does in the fall? Or, this is a 13-week model, but you can kind of apply that across the board. And, sales might be even on that accrual basis, but really looking at when does the cash come in? When do you need to spend your cash, whether it be payroll, vendors, your rent, your utilities? This approach really kind of magnifies the ins and outs of your treasury. So we said earlier, why 13 weeks? It's a detailed view of the sources and uses of cash in your organization. It's roughly 1 quarter. And for many of the businesses or entities on here, that's, usually the length of the operating cycle for cash. And it forces companies to really look at the entity in a more granular level. And what does that mean? I would imagine most individuals here, entities here are looking at budgets and forecasts on a monthly basis, or looking at their cash projection on a monthly basis. And that is very helpful. It absolutely is. But there are times within the month that you're able to, you might see that you're collecting a lot of receivables in the front end, and cash looks great. But the week after that, or 2 weeks after that, you have payroll and you have rent and utilities, and your debt is due. And all of a sudden, cash is gone, or it's dipped below what you would expect. That, looking at this on a 13-week or a weekly basis, is something that you're able to identify that you might not otherwise see on that monthly or quarterly basis. The time frame really being a quarter is long enough to make strategic decisions, but it's short enough that you can make informed decisions as well, and it should be quite accurate. You're not trying to forecast a month out or a year out from now. It's really, 3 months, and you guys are all business owners, entity owners. You know your organizations quite well, and you're able to kind of forecast in that near term. Obviously, we're in some unprecedented times, and things are changing weekly, daily, sometimes even hourly. So that's tough to address. But the better informed and planned you are is important. And lastly, this exercise, this model, this tool is important that it's independent of month close. So you're able to look at your cash projection, your cash position, almost on a real-time basis, at least on a weekly basis. You don't need to wait for month end, which might happen a week, 2 weeks, some entities 3 weeks after the previous month end closed. And that's not going to give you valuable data. You're already 3 weeks behind on what has happened. So really looking at this cash basis and not really, as your month end might be an accrual basis, it kind of helps you be more nimble and more ready to adapt for any changes that might be needed. So kind of review of what we just went through. Cash flow management is to forecast and manage timing of cash flows to assure you have availability to accomplish your mission. You guys are already really good at what you do. Let's make sure you have the cash to be successful. It's important to know your income statement might show that you're profitable. It might show that you have net income, but that doesn't always mean you are cash flowing or you are cash positive. It's important to understand the distinction between those two items. We talked a little bit earlier, but the forecast will help you be prepared. You don't want to get to week 6 of your forecast and realize that you're, $100,000 short on cash, and then you need to make that decision quick. If you're able to look at that, like I said, 6 or 8 weeks ahead of time, you're able to plan accordingly, understand maybe what financing needs you might need. Is there any capital contributions? Are there other things that we'll talk about down the road that can help conserve cash or bring cash in quicker? But again, you're planning ahead so you know where these issues might lie, and you can develop a plan well ahead of time as opposed to being reactionary. And like we said, a weekly forecast captures movements that you might not see otherwise in your monthly or quarterly budgets or forecasts. It really helps you be nimble and helps you be able to react, be proactive, and be able to address the issues at hand. Because again, things change quite rapidly that we've definitely seen. Some industries more than others, some size of companies more than others, but it's different amongst everyone else. But being able to see things at a granular level and being able to adjust is going to help you be successful. So poll question 2, as we've kind of discussed, how much has this pandemic really affected your entity? We have some clients that nothing's really changed, and some that, we're not sure they're going to make it. So it's anywhere in between.
Just a few more seconds on that poll question.
That's encouraging. That is encouraging. We've been quite busy at Wagner just to reach out and help to any of our clients and prospects, and just be a voice and a teammate. And we've always prided ourselves on being advisors and making sure we have the right people at the table to bring everyone in to make the right decisions. And that's not to say that only the accountants can help that, but bringing in bankers and financial advisors and your whole management team is really important to kind of factor into all these different things that we have talked about. We will talk about later in the slides, but it's definitely a team approach. So.
All right, thanks for the intro here, Kyle, and some background. So we'll get into some prerequisites for our cash flow forecast. One of the main things is that we're going to need to know, where we are, recognize that, what is our current and historical financial story. The second piece is, in this pandemic environment, what kind of impact is it having on our customers? What kind of impact is it having on our suppliers? And also internally, what impact is it having on our people and our operations? And then we'll use kind of those data points to develop the model and the forecast, and we can adjust our operations as necessary. So kind of the initial assessment is, what are our numbers telling us? What are our current levels of working capital? Do we have any reserves? What is the availability on our line of credit? Do we have additional sources of credit? Could there be a shareholder injection, or can we reach out to our banks to set something up? And so what we'll kind of do here is look at our historical balance sheet and income statement to develop that baseline, and we'll use those data points to forecast. So from the balance sheet, we can use some ratio analysis to help understand where we are. We can use the current ratio. We can use a liquidity ratio. We can look at what the number of what the number of weeks of cash we have on hand. We'll also want to calculate our days sales outstanding, our days payable outstanding, to see, what is our historical, cash collections. Is it typically 30 days? Is it 20 days? Is it 60 days? And also with, how quickly we're paying our bills too, so that days payable outstanding. From the income statement, we can figure out, what are our fixed costs, what are our variable costs, and just understanding what those are. So our fixed costs are those expenses that don't change if our operations are up or down. They're fixed. They're going to happen probably at regular intervals and typically don't change very much. Whereas our variable costs are, take the example of a manufacturer. So if production is up, our production labor costs are going to be up, and if they're down, they're going to be, the variable costs of those are going to be down. So understanding kind of how those fixed and variable costs interact is going to be important. We can also use our historical data to find averages, trends, identify some KPIs, and then kind of, before we get into the model itself, I know that there are some accounting softwares out there that do have, a bolt-on cash flow forecasting. So if you're not very familiar with how to do it, that might be a good place to look. Not all of them do, but it could be useful. Kind of the other thing is, as you're going through the exercise here, you'll uncover some information about yourself, and then also the future. And it's probably important to, maintain open lines of communication with your banker. It probably wouldn't help to share your outlook and plans if you see fit. So one of the things that I like to do when I'm doing this is to prepare kind of a size income statement. So the one that's in front of you here is on an annual basis, but you could do this quarterly, you can do it monthly, semi-annually, kind of whatever your needs are if you have some seasonality to your business. But what we have is, I have 4 years laid out here, and then to the right, we have, each individual expense line as a percentage of total. And so what you can do with this is identify it gives you visibility into identifying your fixed and variable expenses. We're going to use these percentages to develop some baseline assumptions. Kind of the other interesting thing with this is you can use these percentages to compare yourself with some competitors. If you're a larger company and you want to compare yourself with maybe some publicly traded companies that are in your industry that you compete with, you can use this common size financial statement to see where they are compared to where you are as well.
Tim, going back to when you were talking about software, do you have any recommendations for software that would be able to have this report for cash flow?
I don't. The model that I have is Excel based, but I know that there are some out there, and I do believe that we could probably ask some of our accounting service group people what they use, because I think they use some of this stuff. So that can be a question that we can follow up with at the end.
Sounds great.
All right, so now we're going to look at, a spotlight on customers and vendors and ultimately our organizations and personnel that we have. So in light of the situation that everyone is now in, this really gives business owners and leaders an opportunity to really develop and cultivate the relationships they have with their customers and vendors, making sure that we're having touch points with them and having open lines of communications, because this is, it's not just affecting one industry, it's not just affecting one company. So everyone's this is going to be cliche, but everyone's in this together. So making sure that everyone is just in constant communication is going to be beneficial to, making sure you're running a successful organization. But looking at these forecasts, you might be able to develop, and you might already know, what kind of revenue do you have? Is it reoccurring? Does it happen sporadically throughout the year? Or do you know the same customers ordering the same same parts every week, every month, every quarter. It really depends on the customer base you have to know the different assumptions you'll need to help make these cash flow projections. Do you have a certain customer concentration? Is there one, that might be a majority of your sales? And if that's the case, or maybe even less, how is this pandemic, how is this current economic environment affecting them? Really getting, knowing your current events, knowing your customers, knowing your vendors is super important. And being aware of, you might hear news out there that doesn't really affect you, but it could affect your customer. And because of that, that's going to affect you. So being aware of those items out in the news and just in general is I think, really important. And we've talked to our clients about that, and they've definitely, been proactive and looked at some of their customer bases prior to us having discussions with them, just so they know what's going to happen. On the revenue side, what are some ways that you can make sure you're getting cash in the door? Is it something that you could increase your billings? And by that, I mean, not increase a dollar amount or just go sell more, but can you bill more frequently? If you normally bill your customers on a monthly basis, can you do that semi-monthly or weekly? Just trying to get cash in the door a little bit quicker than you normally would have. Ultimately, cash is king, right? So in looking at existing customers, existing AR balances, do you have some outstanding balances that you could work on collecting? And maybe it might not be 100%. Maybe it's some nominal percentage, 50 cents on the dollar, 70 cents on the dollar. But that's better than not receiving that cash at all. So again, just having those open communications with your customers is really important. Can you incentivize or change your structure that your customers are paying? If they pay quicker, they're going to get a bigger discount, or they'll get a discount on future purchases down the road when everyone gets out of this situation. It's just really important to understand what your customers are doing, and that's going to take more than just management to understand, or just the finance department. You really have to work with sales and marketing and kind of everyone to really get a good understanding of your forecast and what are some ways to, get the money in the door and making sure sales are still there.
Yeah, as an example, I was just a couple of weeks ago talking with a manufacturer that we work with, and they initially didn't think that this pandemic, COVID-19, was going to impact them too much. They're like, yeah, we're an essential business. The orders are still there, so we don't think we're going to have too much kind of impact in this environment. But then, the next week, their biggest customer, who's maybe 40% of their sales, shut down, and now those orders are gone. So they had to kind of react relatively quickly.
Absolutely. That's very similar to that too, Tim. So kind of what we talked about before, things change weekly, daily, hourly sometimes. Things might be great, and who knows, at the end of this conversation, something might have changed. I mean, you never know. So next, kind of a spotlight on the suppliers. And what is this environment really having on that supply chain? How are suppliers for your goods and services being impacted? You want to make sure that you're able to, you're making widgets, making sure that you're still able to get your steel or your plastic. But what are those vendors? What have they experienced? Do you have alternative vendors that you could use for your critical items, your essential items? Maybe you don't need them now, but to have that contingency is definitely key to, you want to make sure that if the supply chain is disrupted, which it inevitably has already been done, you're able to kind of adapt quickly and still make sure you're able to make your good, purchase your inventory. Ultimately, too, here's an item, you're looking at your cost of sales and your vendor payments, and Tim will talk about looking at, changing the day's purchases outstanding. But is this a time that, you're having your relationship with your customer or your vendors? Can you renegotiate terms with them? Can you negotiate the length of payment? And we want to make sure that it's not you're not trying to take advantage of the situation, because again, everyone is in this together. But is it really an opportunity to really, in good faith, renegotiate these terms, and it could be beneficial for the whole relationship. Ultimately, can you extend payments a day or two, 5 days? As Tim will show in the model, a couple days extending payments can really make a difference on your cash flow weeks down the road. And again, putting that all together is important to kind of see that. Next, on your suppliers, can you tighten your purchasing approval or decrease the threshold of what you would normally require in approval? So let's say you normally require 2 signatures on approvals over $2,500. Maybe you reduce that to $500 now, just so you really have a good picture on what you're spending your money on, making sure you're not purchasing items, inventory that you don't need at a certain time. I think it's really important to kind of have these policies in place, just so you're really having a good aspect and a good approach on your cash needs. Tim, do you have anything else to add there?
No, I think that kind of covers most of it. You know, it's also kind of just, you know, internally think to yourself, what kind of conversations should you be having with your vendors and suppliers?
And here we spotlight on people and operations. This is probably the most important, or at least the most time intensive, that the business owners and business leaders are spending their resources and time on, because it's your company, it's your organization, it's your people, your employees. Sometimes it's your family. That's what they feel like, and that's what you want to make sure that is, you're treating them with respect and making sure that they're treated with the way that you want to be treated. But at the same time, it's, you know, thinking carefully through what changes might need to be made. Ultimately, business owners don't want to let go of their employees. That's the last resort. But, you know, are there other options before that will really help reduce this cash outflow? You know, something, is it just doing short-term furloughs as opposed to a complete firing? Is it decreased hours so people are still able to work, maybe not what they would normally work, but something a little bit less? Can you spread the work out a little bit? Business owners might not want to hear this, but maybe you decrease distributions, and the distributions are really only to cover your tax liability, your tax needs at that time. So it's just kind of thinking of these different options to kind of slow the bleed of cash, but at the same time keep your personnel there so you're able to be successful in your business. Another thing about operations is looking for unnecessary waste. Are there capital expenditures that you think you can kind of forego for the time being? Can you defer these types of payments? You know, there's risks with that. Maybe you're not able to add on this new piece of equipment you're expecting that's going to change your capacity down the road, but maybe you're able to save $100,000 at that point in time, and that's more beneficial than, you know, just trying to make it through. You know, are you able to sell equipment to increase cash? Maybe you have some idle equipment or idle inventory that you really aren't seeing an ROI on, that you can probably have an influx of cash there. Ultimately, there might be product lines or products themselves that, you know, you've been meaning to get around and really maybe scrap or really revamp what you've worked on there because it hasn't made money or it's lost money, but you haven't done it. Maybe this is the time that it kind of forces you to do that. So it's really kind of evaluating your operations, your product line, what you're working with, and maybe eliminating and reducing some of those things that aren't as profitable as you would have expected. And ultimately, I think we want to make sure that when you get to a point on personnel, you want to make sure that you really carefully think through all the options, all the repercussions, all the outcomes, to make sure that's what you're comfortable with and what the results you think are going to happen. Tim will look in this a little bit, but you know, you think you might be able to lay off 10 people and that's going to save a lot of cash. When you look at these forecasts, that will have a smaller impact than if you're able to increase your receivable collections or extend your payment terms. You know, it's a bigger change in cash inflows and outflows on, you know, the top side of your income statement rather than reducing some personnel on, the operating expenses. So it's an important part of the organization, but, really thinking things through and trying to think outside of the box to keep your employees and keep your organization going. So.
Yeah, I think it's, as you mentioned, it's kind of an opportunity to, maybe you were thinking about cutting some expenses before all of this, and, now is kind of the right time just to do it. In regards to personnel, obviously we want to not cut any jobs or reduce wages or furloughs or anything like that. But, if we're looking at our forecast and we're not seeing any other options, I mean, sometimes we got to make the hard decisions. And when it comes to that, there's the old saying of, measure twice and cut once sort of thing. So making sure that your decisions are fully thought through and, news is delivered swiftly.
Absolutely. So a quick review on that. You want to look at where you are based on your previous assessments and where are these possible risks, based on your discussions with your vendors and your customers. How do those things change? Using the weekly cash flow projection really helps you understand your sustainability in general, your cash levels, your solvency, your ability to extinguish current liabilities, and making your debt payments. Making sure that can happen is imperative, obviously. And some items that we just, we talked about are increase the frequency of your billings, trying to get cash in the door quicker, and potentially extending payment terms. Again, Tim's exercises, I think, going to be eye-opening, but showing, can you extend a day or 2 or 5 days really might make a difference. So.
All right, so that brings us to poll question number 3. Has your company applied for any of the relief funds available? So the Paycheck Protection Program, or maybe the Economic Injury Disaster Loan Program? Oh, that's great to see that there's a lot of people already applied, approved, and received funds. It's encouraging to see that people didn't apply. Hopefully that's because they didn't need to. All right, so now we'll actually get into kind of the model itself. Where do I start? So some of the people were more experienced, so this might be kind of rudimentary, but we're going to label our 13 weeks across the top, and then down the rows, we're going to have our kind of beginning cash balance. We're going to lay out our cash inflows or our cash receipts. Then we're going to go with our cash outflows and ultimately come down to our ending cash balance on the weekly basis. So using kind of all the information that we've previously talked about, so information about our customers, information about our suppliers, information about ourselves, what are our typical days sales outstanding, days payable outstanding. We're going to use all of that to actually build the model. One thing that would also be useful is to, before you start week 1, week 2, week 3, week 4, maybe it might be helpful to set up, what were the actual previous 4 or 6 weeks cash flows, and just model out what the actual is. That way you can see kind of, what trends are you seeing, and, what are the timelines or payments, when are things being paid? So, payroll is pretty obvious. We know when that is due. Rent, health insurance. Maybe there's something in there that you didn't think about initially, like a credit card payment. Maybe that's due at an unusual day of the month, like the 16th or something like that. But laying out the previous actual will probably uncover some information that'll be useful to you in your forecast. So the cash inflows. What we're going to do first is we're going to take our current accounts receivable listing. Using that information, we can lay out when we expect that cash to be collected. So, if we're looking at it today and we're looking at one specific invoice, maybe our typical terms are 30 days, and generally everybody pays on 30 days. So we can look at our current listing to forecast out what weeks we can expect those payments to come in. And then we're going to use our sales forecast to estimate future collections on the remaining weeks. So that's going to require you to talk with management, maybe the sales department if you have one, just to kind of see what's in the pipeline for orders or sales, or if you're a nonprofit, maybe donations. I guess one tip to keep in mind is that we'd recommend you be conservative with your sales forecast. That way it'll better stress test your cash position. So if you're overly optimistic, that'll probably hurt you more than if you were a little bit pessimistic. And then for our cash outflows, we're going to use, it's kind of the same thing with receivables, we're going to do with payables. So we're going to look at our listing, see how long it's been in our accounts payable listing, and forecast out when those payments are going to be made on a weekly basis. It's an opportunity to separate our fixed and variable costs. It's also a way to identify our disbursement patterns. So payroll, is it monthly? Is it bi-monthly? Do we do payroll bi-weekly? Kind of laying out that on the actual spreadsheet itself, along with, maybe your mortgage or your rent payment, utilities, health insurance. Those are kind of some of the larger ones. You could have a credit card payment on there if you use your credit card heavily.
Tim, I was just wondering if you knew where I could find a faucet like that just spews out 20s.
That is my personal one, and I'm
okay.
Not, so
perfect.
I wish that would be something, huh?
Once social distancing is done, we can touch base.
Oh yes, social distancing. So then we're going to use the assumptions that we've identified from our historic size income statement to forecast out the remaining weeks.
Going back a little bit, we had a question come in that may be specific, but it also might help other people on the call. Somebody wrote in, we're an employee-owned cooperative with 11 owners. Can you recommend any sources of credit, preferably a line of credit without owner personal guarantees?
That's probably going to have to be various banks and seeing what you can negotiate with them. Being a small company, generally speaking, the banks will want that personal guarantee on there, but maybe you can negotiate some other type of collateral to secure the line of credit.
Awesome, thanks.
All right, so in the model that you'll be seeing in a little bit here, I put together kind of just a simple average for weekly revenue, and then adjusted it based on the current environment. I separated out some of the larger fixed expenses, and then I used the annual percentages to estimate variable costs. The model does not take into consideration any seasonality or anything like that. And then here are some of the assumptions used. So, from that common size income statement that we had shown previously, there was about $7.5 million in annual sales. So the company was estimating maybe 4% growth. That gets us to $7.8 million in annual sales, which is about $150,000 in weekly sales. However, given the current COVID environment, we are expecting sales to be less than that. And additionally, we're expecting it's going to take longer for us to collect our cash. So typically our normal environment is 30 days. In the current environment, right now we're looking at 40 days. And so we responded to that also by making our payables about 40 days. Our fixed costs, we've got payroll, which is bi-weekly at $55,000, health insurance, and then I lumped together some other fixed costs, and then our variable costs are there as follows. Again, the model is, or the example is, I won't say it's simple, but it's trying to give you an idea of, if we change days payable outstanding or days sales outstanding, what impact that has to the cash position. I'd encourage you to set up formulas in the Excel file to kind of try to automate things as much as possible, take that human error out of it. Some other things to keep in mind are you can tack on maybe the available line of credit to see where that's at on a monthly basis or on a weekly basis. If you have certain borrowing base requirements, maybe you can add that to the spreadsheet too. So now we'll flip over to that model here. Just give me a second. All right, so if we go back to this first tab here, here's our common size income statement that you saw on the previous slide, and then where I got my information for my variable costs. So that 56% number for cost of goods sold, our variable personnel, our fixed personnel. These are all just formulas based on where we are currently, which went into our assumptions on that previous slide. So when you get to the actually putting it together, as we mentioned, we're going to lay out our weeks across the top. So we got week 1, week 2, week 3, and so on. But what you could do is put those prior weeks in here too, just to work with the spreadsheet, get familiar with it, and see where you actually are. Since I'm not dealing with live company data, I don't have any of this, but it'd probably be a good exercise to do if you're not as familiar with building a cash flow forecast. So we start with our beginning cash, and then we have our cash inflows, and here is our accounts receivable that I mentioned to get to cash outflows, and then ultimately our ending cash balance. So the step 1 would be our accounts receivable. So I've got that laid out on a different tab in here. So what I'd encourage you to do is lay out your, export your receivables aging from your accounting software by customer and then amount and probably an invoice date, so you can do some formulas to figure out what the due date is, and then you can figure out what week it is actually going to be received in, and then that'll ultimately flow back to cash flow forecast here. Then we get to our, after we figured out our accounts receivable, we're going to look at, what's our sales forecast look like. So I've got that across the top here. You can put it in, another tab if you want, but we'll leave it on the top here. And so, our baseline was that 150 I mentioned, but in the current environment, we're looking at 112. You'll see it kind of stays relatively flat, dips down a little bit, but then at the end of the 13 weeks, we're thinking we're going to be back to about 100% here. As I mentioned, the days to collect, we're looking at 40 days sales outstanding, and that's relatively consistent until we get to the end as well. Because what we're going to do is to figure out these numbers in here, is we're going to use these days sales outstanding to determine what week we're going to collect this revenue. And then when we get to our cash outflows, we're going to see our accounts payable is going to be the same thing as our accounts receivable. So you could itemize your AP aging listing by invoice amount, invoice date, put in formulas to figure out the due date and when it's going to be paid, and then ultimately bring it back to your forecast here. Then I'd recommend breaking out our fixed and variable costs. So our variable costs, this is a manufacturer, so I know not everybody's in a manufacturing environment, but maybe you do have some other variable costs. So here we have our goods sold, payroll, and then operating expenses, and these are all just formulas based on the sales that we're predicting. And then we get to
a couple questions if this spreadsheet will be emailed, and the answer is yes, it will.
Yep, we'll email that with the slides at the end.
Mm-hmm.
Then we get to our fixed costs. So generally speaking, payroll is probably, you know, if you're not a manufacturer, payroll is probably your biggest expense. This is a bi-weekly, so every 2 weeks. Health insurance is paid kind of at the end of the month here. And then we have our other fixed operating expenses that we've identified. You know, it could be phone and internet or some of that type of thing. Then in this scenario, there's also a monthly loan payment that's due. So while we use our income statement to kind of develop some of these assumptions, there are some other items that are not on the income statement that need to be considered. So loan payments is kind of a big one. If you have fixed asset purchases, that would go in here as well. Owner draws, again, don't hit the income statement, but it does impact our cash position. And ultimately, you know, using this model, we see, you know, we start with 100,000 here on day one, week one, and we're looking fine for weeks, you know, 1 through 8, but then week 9 comes and we're flipping to negative here. And as Kyle mentioned in a previous slide, you know, looking at the timing of disbursements, just the end of June is just a big week. We got, you know, our AP that's being paid. We got payroll that's hitting. We have our monthly health insurance that's hitting. I got our loan payment, and you know, 2 months from now, it might be a bit of a cash crunch. So what can we do to try to mitigate that? You know, let's say we can change some of our days sales outstanding. Let's say we can, you know, we're looking at 40 right now. What if we try to get our customers to pay just a little bit quicker? So let's change these to 35 days. And all of a sudden now we just changed one number and week 9's positive. You know, let's do it again. And you can kind of see the impact that changing sales, that collection time has a pretty significant impact as to what our cash flow is going to be doing in subsequent weeks. You know, the same effect is on our days to pay thing. So if we extend those out, maybe we go out 45 days here, 45 days there, you know, you'll see kind of the impact several weeks from now that, you know, we're going to put ourselves in a better position. So I'm just going to undo those just momentarily here. And just to give you some sort of idea as to, you know, if we try to cut expenses, non-payroll stuff, you know, what does that do to us? So if we take our kind of variable operating expenses, our historical number was about 7% of our sales. Let's just say we cut that to 5%. What does it do to the model? Doesn't really do much. Doesn't turn the dials as much as collecting those outstanding receivables or extending our payables does. You know, payroll is going to have, this is variable payroll, but, you know, let's just say we reduce that. You know, it has somewhat of an impact, but, you know, the bigger thing is these fixed payroll costs, so we'd have to change that. Or if we try to negotiate maybe with our suppliers, maybe we can negotiate a 2% reduction in costs. What does that do? You know, it doesn't move the dials as much as trying to collect our cash does or extend our payment terms is, I guess, the theme of what I'm getting at here. So depending on your situation, this is something that, you know, should be updated weekly, or, you know, if you're in a pretty good position, maybe it could be done on a monthly basis. But either way, you should be comparing the forecast to the actual results. For the comparison, update your forecast and change any changes in any of the assumptions that you have. Maybe your cost of goods sold margin isn't actually 56%, maybe it's 50%. That would have an impact. Maybe your days to collect is better than 40 days. Maybe it's 35 days. Doing that will help you effectively plan out kind of the future till we get to maybe normal operating capacity here. But it's also good to do this on a fairly regular basis just to see where you're at. So you can identify maybe some potential shortfalls. You can monitor your collections. You know, if you're doing this on a weekly basis, you'll see those customers that maybe aren't paying on their 30-day terms. Maybe they're paying on 40 days, and it's an opportunity to give them a call and have a conversation. You can plan for capital expenditures. Maybe you can make an additional principal payment on your debt that you have outstanding.
We had an awesome question come in that I think a lot of people might have. Let me just go back up to it. So how would you recommend setting this up, giving the effort of tracking PPP funds that come in? Combine all the cash in one forecast, or keeping PPP forecast separate from general cash?
Well, we have, I guess in here, I'd probably put the PPP funds in, you know, if we're doing this today and we haven't received it, then I'd probably put it in here because that is going to be a source of cash, and we're going to use that cash to make our payroll. As far as tracking how we're spending our PPP, that should be done outside of this, because this is going to be kind of as a whole for the company or organization.
Yeah, PPP should be kept very separate. We had somebody just comment that. So making sure that that's tracking separately.
Mm-hmm. Important enough to make sure that the cash inflow is factored in this model.
Awesome.
Yeah.
And then, so you put your actual cash in and outs in the projection, making this a combination of an actual and projected cash flow. We just had it one attendee wanting to clarify that.
Yeah, so I think it'd be helpful to, you know, if in here, map out the actual cash flows for the prior 4 weeks, so you can get a sense of what the timing of payments are, how much they are, and then do your projection. But then weekly, you know, say we're at week 2, you know, I projected this for week 1. What was my actual week 1? And, you know, maybe we're not actually going to pay AP. And if we paid 50,000 of AP, that means that other 15's got to go somewhere in here. Plus we've received invoices, so that's going to go, are going to change. So it's a good exercise just to see where you're at, in addition to what your assumptions are. So we've estimated variable payroll at 8% of our sales. You know, what was that actual variable payroll that we had? Is that assumption of 8% accurate, or is it higher? Is it lower? You know, that looking and comparing actual to budgeted is going to help you a lot in refining and tweaking the model to make it more accurate as you go along. And it'll be easier the more you do it.
Awesome. So we are out of time for the day. Tim and Kyle, do you have any last minute comments for all of our attendees?
Sorry, I didn't expect us to run out of time here, but I guess kind of in summary, recognize where you are, make sure you assess your environment. So think of your customers, your suppliers, your people, identify and respond to those risks, discover opportunities. You know, as far as doing the model, you know, start small, just do it for a month maybe, and then make sure you're comparing it to actual, and keep this forecast a rolling weekly thing.
Awesome. Kyle, anything else?
I think it's just being proactive of the approach, making sure you're aware of what's happening in your environment, and planning for that as such. Again, it's a trying times, different times, unprecedented times. So the better you are prepared, the better you're going to be set up for success with your entity.
Wonderful. Well, thank you both so much for all of your expertise and awesome tips. I will be sending out the recording from today, the PowerPoint slides, and that awesome Excel worksheet that they both put together. So thank you all for joining us. Keep an eye out for other webinars we have coming up. Tomorrow we have 2. One is for I've received my PP funding. Now what do I do? We have one for businesses and one for nonprofits. So make sure to sign up for those if you do have any questions. We so appreciate all of you joining us today, and we hope you have a wonderful rest of your day. Thank you, Kyle and Tim.
Thank you, everyone.
Thanks, everybody. Take care.